Hello and welcome to episode 4 of my weekly portfolio update here on The Last Investor. My name is Dan. Thanks for joining me on this fun and bumpy journey to financial freedom. My goal is to use dividend growth investing strategy to grow my portfolio long term. I invest £200 every week and update you on my experiences through the highs and the lows. I follow 4 rules in identifying a core group of stocks that I invest in. I then allocate my weekly funds to the ones that drop in value. The lower they drop, the more I allocate my funds to them. Also, by investing weekly, I'm able to follow the market and hopefully I'll make the gains when they go up. But most importantly, those dividends will be instrumental in the growth of my portfolio overall. So today, the topics I'd like to cover would be just to give you a portfolio update. I'll look at what my allocations were for this week, what stocks I've added to my portfolio, and just give you a general overview of my take on the portfolio as a whole. I'll then explain to you why I prefer volatile stocks that have strong fundamentals. And without any further ado, let's get right into it. As you can see on the screen, my value is currently at £1,409.61. Portfolio has effectively dropped 6.03%. The amount put into the portfolio is about 1,500. So basically it's dropped by £90.39 as a whole. The main stocks that have taken the most hits remains the mining stocks. That's basically Rio Tinto, as you can see at the top there, and also BHP right at the bottom. So those are the ones that have taken the most hits. Rio has fluctuated between 10% and 12.5%. Whereas BHP is dropped as low as 16%. I think it's actually currently just under 17% now, drop in value. I'll talk a little bit about the reasons why I think the mining stocks are generally down. Then in terms of the other stocks, the 2 stocks that I have also dropped in value, basically Trig, which is down 0.56%, and 3i, which is down 1.42%. Bellway and Mundi both up roughly around just over 1%, which is great actually. I can't complain too much about that. I guess you'd notice that I've got a new addition to my portfolio, and that's Aviva. Aviva is actually, I did a little bit of research into the insurance market, and I found Aviva and Legal in General both very, very good stocks. They've got strong fundamentals, strong balance sheets, and they're both relatively, they're growing. They've got income growth, year on year income growth relatively, which is not bad. But I had to pick one. I didn't want to go for both, and the one that seemed the stronger to me was Aviva. Aviva's got about its balance sheet is really, really excellent. Its total debt to equity is about 0.49. For anyone who knows what that means, basically it's for every £1 of equity, it only has about 49p of debt, which is very, very strong. And in terms of total debt to cash and cash equivalents, so for £1 of cash and cash equivalent, it has a total debt of 60 pence. So if it decided to pay all of its debt, including its long-term debts, it could do so and still have some change in cash. So that's pretty impressive in terms of the balance sheet. Now, in terms of its year-on-year growth, I think its income growth has been roughly about just under 10%, so that's not bad at all. Especially when you're talking about a company that's been around for, well, since the early 1900s, so or even late 1800s, so from the 19th century. It's still growing, so you can't really complain about that. Insurance is a relatively stable sector. When in terms of competition, it's very rare that you have that industry disrupted, and that's probably not likely to change anytime soon. So that seems like it just seems like a no-brainer. The other reason why I like this stock is because the dividend yield is really high. It's about 8.6%, and the payout ratio is about 32% of earnings. So it's only paying out 32% of its earnings in dividends, and it's yielding 8.6% of the actual price that you pay for a share. That's incredible. Really is incredible. Then when you look at the actual value, it's 6.2 PE ratio. Again, for those who don't know what PE ratio is, basically it's price to earnings. So for every earnings, for every £1 that the company makes in earnings, for every £1 a year the company makes in earnings, you're paying 6.2 times that in price. Another way you can look at that is basically you could buy the company could pay itself back through its earnings in 6.2 years time if it continues to earn the same amount of money at this price. So obviously the lower the PE ratio, the cheaper the company is. The higher the PE ratio, the more expensive it is. Warren Buffett sort of goes for PE ratio of 15, so anything below 15 is considered really good value. Anything above 15 becomes a little bit more expensive, but you can have PE ratios which go into the 40s and 50s and 60s, especially growth and tech companies in the US. And the reason why they sell for that much is simply because they're stupid. The buyers, I guess, but I'm just kidding. But no, I mean, really, no one should be buying anything at PE ratios of 50, but they do exist out there. It's just crazy. I don't know. It probably goes as hand in hand as the same reason why people basically buy high and sell low. But there we are. Enough about that. So that's why I've got Aviva in my portfolio at the moment, really selling out to discount as far as I'm concerned. So I bought 25 shares, and since I bought the shares at 25 at £3.59 average, it's since gone up and it's now trading at £3.62. So I was hoping to get a little bit more, but then my rules, for those who follow my videos, my rules is not to buy when something goes up in value. So if it's green, I'm not buying. If it's red, I'm buying. So I'll have to wait for that to go into red and hopefully fall below that. Fall below that £3.62 or £3.59 average that I currently have, so that I can get those average down, average price per share down. That's my aim, to get those average price per share down long term for all of my holdings and all of the stocks that I hold. So that's me jabbering on too much about Aviva, but there we are. That's now in my portfolio. I'll be investing in that long term. Now, just to talk a little bit about my allocations. I had allocations for Rio. Obviously, as you can see, it's the biggest drop in value, so that's why I've invested in that. So on the 15th and the 20th, I invested in total about £120, and so that takes my stake up to my full value up to about £550 and that. and my average has now dropped to £44.79. When you compare that to the very first shares that I purchased in Rio, that was trading, in fact, just going back to that was trading at £48.40. So my average has come down quite significantly since then, and that's the beauty of buying when shares are going down. Basically, you get an opportunity to reduce the your average price if you continue to buy when the price drops, as opposed to investing in your other stocks which are increasing in value. By just ignoring those ones that increase in value and buy when the value go down, you eventually ultimately drop the average price of your total holdings. So that's what I've been doing. Then when we look at Trig, I bought 110 shares of Trig between the 14th and the 15th. That was just leading up to the ex-dividend date. So I made sure I got a few shares in there before the ex-dividend date. So in total, that was roughly about £137 that I invested in Trig, which is not bad. Again, the average price is down to £1.29 from my very initial buyings of, I think my initial purchases were around £1.30. But Trig's share price has stayed roughly around the same anyways, but it keeps going up and down. The cheapest that I purchased the Trig for is actually £1.25. So I've purchased a few shares at a relatively cheap price, £1.26 there. So overall, not doing too bad in terms of getting the average price down for Trig. Then I also purchased a share in Bellway. It went down for a little while, and then I just thought I'll buy a share in that. So I bought it at 28.01, and now it's although it's down, it's still trading at 29.07. So I took advantage of that, I think. Then I obviously bought 25 shares of Aviva, as I mentioned, which is roughly around £90. And 2 shares in 3i. So there we are. Those were the total allocations I had around that period, 14th, 15th and the 20th of August. Now going back to Rio, before I even talk about Rio, let me talk about the state of the economy at the moment. I mean, the trade wars appears to have intensified quite a bit. Obviously, we know that China came out and announced in the middle of the week about imposing tariffs on US goods, and Trump, in a very predictably and should I say reliably, fires back a classic tweet announcing that he's going to increase the percentages on the planned tariffs on China imports. So I think one was going to be increasing from 5% to 10%, and one from 10% to 15% or something ridiculous like that. So that's not going away anytime soon, and I can only see China retaliating with more tariffs, well, possibly, but it's not good. Ultimately, it's not good. And as far as I'm concerned, do I really care? No, I couldn't care less. All that's important is that it creates more opportunities in the market, and buying opportunities, and that's why I like volatility. The more volatile the market, the more opportunities will arise in terms of things which are good will drop in value and then create buying opportunities. But at the moment, it's really difficult finding great stocks at good prices. most of the stocks in the market are relatively average, and even though they're average, they're really overpriced, and it's just not good. You've got some other stocks which are really poor. They're really just not good stocks, but they're still overpriced. It's just crazy, and I don't know how these stocks are really overpriced when they're poor. And when I mean poor, I just mean that in terms of the fundamentals of the business aren't necessarily great. Then you've got things like their balance sheet looks really terrible, it's just, and it's the PE ratios are really high. Just so many things not right about them, but yet people invest in these businesses. It may be that some people got into them when the prices were really low and when the fundamentals were really okay, and obviously you've got this overly inflated market at the moment, and they look bad. They look extremely bloated, some of these companies. So of course, whoever's got into them when they were really good would want to remain in them, which is fair enough, because they may be getting dividends from them, etc., and that's fine. You can't really criticize them for that. But people buying at the peak of the market now, that's what gets me. That's what I just can't understand why anyone would buy at the peak of the market. But there people are doing that. But there we are. As I said, I've looked into the market, and all I could just see really is really high PE ratios. I mean, I don't really want to pick on big brands, but there are some big brands out there as well which are really bloated. McDonald's is a classic example. Let me just to break down McDonald's a bit. So McDonald's is currently running on negative equity. Now, for anyone who doesn't know what negative equity means, is if you look at a company's balance sheet, you would see that it would have total liabilities and total assets. Now, a company's assets is effectively everything that it owns. Short-term assets, longer-term assets, everything put together would add up to its total assets. Buildings, cash, everything. Okay, and its liabilities would include everything that it owes. So that would mean debt. It could mean services that it's already committed to, it's been paid for but hasn't delivered yet, all sorts of things. So all that is total liabilities. Now, its total liabilities is greater than its total assets, and it's currently at a ratio of, for every asset, it has a liability of £1.14. For every £1 in asset, it has a liability of £1.14. So 14 pence more than you could ever pay for, and that's already including all of the debts that you already have. Yeah, it's a big company. Yes, it has goodwill, but all of that's been factored in as well. Goodwill has been factored into its total assets, and yet it's still over. That's what you call being bloated. I mean, looking at it, you can't. Okay, then the other thing you need to another metric that we look at is debt to equity. Now, you can't even calculate debt to equity because it doesn't have any equity. It's got negative equity, so you can't even work that out. It's just got debt. Total debt of £32 billion, total asset of £46.1 billion, and a total liability of £53 billion. So, you go figure with those figures. I'm not knocking McDonald's. It's a great business. It's not going anywhere anytime soon, but it's bloated, and this is quite endemic in the current market. A lot of companies are having fundamentals and figures such as this, and when you look at the PE ratio for McDonald's, it's really high. What is the value that you're buying in there? It's already, everything's already been factored into it. It hasn't really got any equity in it. What exactly are you actually buying at this stage if you're buying into McDonald's today? People who've bought into McDonald's 20, 30 years ago, 5 years, 10 years ago, yes, they may have their reasons of doing so, but people buying into it right now, does it make sense? I don't know, but that's why I'm saying that there's so many other companies out there like this, where they've got they're overly leveraged, and yet they're really highly priced, or they're over their value, and yet people are buying them. It's just crazy. The market at the moment is inflated. That's one thing we have to recognize, and that's why it makes it even more difficult to identify real bargains in the market. And this also brings us to another issue about diversification, or diversification, however you want to call it. But that's also really difficult to find, because I think it's so difficult to find many good deals or good bargains out there in the market. I find it very difficult to see why people could have such a diverse amount of stocks in their portfolio, and that's why I'm also staying away from ETFs. Anyway, I'm rambling on too much now. I'm going to move on. And those are all the topics for other videos, which I might touch upon later. And if you guys are interested in hearing my views on them, and you want me to do a specific video dedicated to any one of these topics, then do drop me a like and leave a comment in the description to the video, to this video. Anyway, moving on, and I want to talk about the mining sector, and why I think that there's been there's been some sort of volatility in that market at the moment. So I think the reason why the prices have dropped from more than 10%, which is actually more than any other sector at the moment, has taken a hit. But this sector, the mining sector, seems to have taken a huge hit, more than anyone else, because it's dropped more than 10% in value. Most of them, pretty much all of the stocks in the mining sector, except with the exception of commodities such as gold and silver, they seem to still be doing well. But apart from those, most of the other mining stocks have taken a really huge hit. One, looking at it in terms of Rio Tinto and BHP, they're more in the iron ore. That seems to make up the majority of their mining stock. And one of the concerns at the moment, or in recent weeks, has been around the iron ore share prices. And the iron ore prices have taken a hit, they've fallen. And I think it's because there's been a lot of fear around falling demand for iron ore in China, because China seems to be, China has been one of the biggest buyers of iron ore because of its manufacturing status. Obviously one of the largest manufacturing nations in the world. So it apparently its demand for iron ore seems to have fallen, or there is fear that its demand for iron ore is going to fall, and so iron ore prices have taken a hit. But then there's also been another concern around one of the other big iron ore manufacturers or miners, and that's Vale. Vale is another huge company that produces iron ore or mines iron ore, and one of its mines in Brazil, there was a disaster around there which caused a dam to breach, and that breach in the dam basically flooded a nearby village called Brumadinho, and that killed 248 people. That was really sad. I think it was earlier on this year, and that's caused chaos, certainly for Vale, who they lost their CEO, they lost a number of top executives. As a result of this, the fallout was huge for them, and the company is going to take a massive hit, no doubt. And as a result, I think we can all imagine that that's impacted on their production of iron ore. And as perverse as it may sound, this obviously benefits BHP, and also benefits Rio Tinto. So I think that may, although they may be talking about demand falling, I think the fact that production and supply is going to fall when you have a big company like Vail not being able to produce to its current levels, that would mean that the BHP and Rio are most likely going to benefit from that, and they may well still come out of this period with decent performances in terms of sales, etc., and production. So anyway, that's my take on the mining sector and why prices are low. So I still think that mining is a real good deal, and I'm going to continue buying at this really, really low price. PEs of 6.1 is crazy. Not very many companies out there at the moment trading at PE of 6.1, and that's just impressive. So I'm going to keep buying at this price, and of course the most important thing is the revenue stream that it's generating, because I'm not buying to sell in the future. I'm buying with the view of these stocks that I hold paying a regular dividend, and that dividend will be obviously the income stream that would in the future just continue to grow this portfolio long term for me. So that's my aim: buy really decent stocks, really stocks which have got very strong balance sheets, which hopefully will maintain that ethos of maintaining clean and strong balance sheet, because I think a strong balance sheet is really important for me, because if a company isn't maintaining a strong balance sheet, then it increases its likelihood. The longer you look out into the future, the likelihood of that company failing increases, because it's like you buy a house for £100,000 and you've got a mortgage of £110,000. It's not sustainable long term, especially if you keep borrowing more money, or if you're making loss. If you're making a loss, you might not be able to repay your monthly payments, which in banking terms or in financial terms is your cover ratio. So if your cover ratio is really, really low, or the more you borrow, the more your cover ratio has to be. And if your cover ratio is really low, then you're a risk. And one of the other things is being talked about is companies like Standard & Poor or so rating agencies such as Standard & Poor and Moody's are talking about changing the ratings of most of these corporate businesses. They've borrowed a lot from a BBB rating, changing them down to less than BBB rating. Now, for people who know what these ratings stand for, basically, if a corporate organization, if their rating drops from BBB rating below that, it becomes a junk bond, or it becomes junk. And so whenever they borrow money, these corporations borrow money by basically issuing bonds. If your rating gets dropped to a junk bond rating, no one's going to want to lend you any money. No one wants to hold a junk bond, especially in this current climate where everything is, we're already in a bubble. We're close to getting to a recession. Who wants to lend their money into a junk bond? No one wants to. And these corporations, if they go into junk bond status, and most of these companies they're not just having a large amount of debt, but they're also continuing to borrow. And if they continue to rely on borrowing, that's where the problem lies. And if they can't borrow, then what happens to them? What happens? I mean, if they have a poor year, or 2 or 3 quarters which are bad earnings, and they make a few losses, and they need to cover even their short-term liabilities, then they'll be in trouble. So that's why it's important as a long-term investor for me to look at companies who are running their balance sheet in a responsible way. They're running their business in a responsible way. They're mindful of their balance sheet. So it's not just about, I don't want to buy a company I don't want to buy a stock that has a lot of debt, or because I think they're just stupid. No, it's about being prudent, because if a company isn't being prudent now, then the likelihood of them being prudent in the future may not be there. And if anything, they're more likely to get into trouble in the future if they're not being prudent now. You can't predict the future, so all we can do is go by what we can see now, and the trend that we've seen in the past, and the trend that appears at the moment for a lot of the companies out there is they're borrowing money, and they're continuing to borrow money, and their debt levels are unsustainable. And when you have a company like McDonald's having a negative equity and debt which is higher than its asset, it spells trouble for me. It spells trouble for me. So there we are. Anyway, I hope you've enjoyed this video. Drop a comment, please subscribe, and I'll see you in the next video. Peace.